Here's what nobody tells you about income investing. While millions chase growth stocks hunting for 10% annual returns, there's a completely different asset class sitting in plain sight: monthly dividend funds that legitimately pay 8% or higher in distributions. Not someday, every month. And this strategy is so underrated that 8 out of 10 retail investors never even consider it. I'm going to show you exactly how these funds work, break down their actual risk profile, because yes, there are real risks, and walk you through 3 specific funds with live numbers so you can decide if this belongs in your portfolio. Let's start with the uncomfortable truth. The S&P 500 currently yields about 1.5% in dividends. A 10-year treasury pays around 4.5%, but closed-end funds, those obscure, rarely discussed investment vehicles, are sitting there paying 8, 9, even 10% annually in monthly distributions. CEF Connect's database tracks over 600 of these funds right now. And while they represent only about 35% of the CEF universe, the ones paying monthly are collectively managing hundreds of billions of dollars. Yet most financial advisors don't mention them in client meetings. Why? Partly ignorance, partly complexity, but mostly because Wall Street makes more money pushing actively managed mutual funds. Now, before you get excited thinking you found the holy grail of investing, we need to talk about what you're actually receiving. This is the part that separates smart investors from people who get burned. When a fund advertises an 8% monthly yield, that 8% doesn't necessarily come from what you think it does. Take JP Morgan's JPI, the JP Morgan Equity Premium Income ETF. It's one of the more transparent funds out there. Their monthly fact sheets break down the distribution composition. Roughly 40% comes from actual dividend payments from the stocks they own. About 35% is from capital gains. And here's the part most people miss: 25% is return of capital. That's ROC. That means they're literally giving you a portion of your own money back, treating it as income. Now that sounds sketchy, but here's why it actually matters for your taxes. Return of capital isn't taxed as ordinary income, it's tax deferred. Your cost basis gets reduced, and you only pay capital gains tax when you eventually sell. Compare that to a treasury bond paying 4.5%. That's fully taxable as ordinary income. For someone in the 24% federal tax bracket, you're really earning 3.4% after taxes. The CEF's effective after-tax return suddenly looks different. That's the hidden advantage nobody discusses. But, and this is critical, this structure only works if you actually understand what you own and don't panic during market corrections. Here's where it gets interesting. CEFs trade like stocks on an exchange. They have an actual market price. But underneath that price is a net asset value, the NAV, which is the real value of all their holdings combined. Most of the time, CEFs trade at a discount to their NAV. Right now, that discount averages 2 to 5%. Sometimes it's wider. During the COVID crash in March 2020, some equity-focused CEFs traded at 15 to 20% discounts to NAV. This creates an arbitrage most investors never exploit. BlackRock's Enhanced Capital and Income Fund, ticker CII, trades at an 8.1% yield. During market stress, if it drops to a 12% NAV discount, you've just bought the same assets for 12% cheaper than they're actually worth. You're getting paid 8% to wait for the discount to narrow. That's how sophisticated investors actually use these funds. Let me give you real numbers. Say you invested $120,000 in JPI at the right time, during a market dip when the discount to NAV was wider. Your monthly distribution at 6% net yield, accounting for fees, would be $600 per month. That's passive income that survives market crashes because it's not dependent on stock price appreciation. It's dependent on the fund's income-generating strategy, buying stocks and selling covered calls to generate premium. But here's where the conversation gets uncomfortable. Vanguard published research in 2018 showing that 45% of monthly dividend CEFs systematically deplete capital over 10-plus-year periods. What does that mean? Some funds just keep paying out high percentages of NAV every month until the fund slowly shrinks. You're getting paid from a depleting asset base. This is why JPI is structured differently. It's an ETF, not a closed-end fund, which means it has different regulatory constraints. It explicitly manages for sustainable distributions rather than max yield today consequences tomorrow. The fund commits to maintaining its capital base while paying dividends. That's a fundamental difference most people skip over when comparing funds. Nuveen's Enhanced Municipal Value Fund, NEV, is a different animal entirely. It focuses on municipal bonds, which explains its 9.2% yield, but also its sensitivity to interest rate movements. The duration is different. The tax advantages are different for high earners. It's not apples to apples with JPI. So here's the actual strategy that works for real portfolios. You don't pick one fund and go all in. You layer them. Imagine you're 62 years old with $500,000 that you want to convert into monthly income for retirement. You could chase 10% stock market returns for another decade, but that's volatile, stressful, and doesn't account for sequence of returns risk. Or you could build a hybrid approach. Allocate $150,000 into JPI or similar equity premium income funds, targeting 6% after-fee yield. That's $900 monthly. Allocate $150,000 into a diversified CEF portfolio of income funds, accepting a wider discount to NAV opportunity for higher yields, maybe 7.5% after fees. That's $937 monthly. Allocate $200,000 into a traditional bond fund or treasury ladder for capital stability, accepting 4.5% yield but with predictability. That's $750 monthly. Total, $2,587 per month from $500,000. That's a 6.2% blended yield. Safe, sustainable, monthly, non-correlated to stock performance on a month-to-month basis. Compare that to a 4% safe withdrawal rate strategy, which would give you $1,667 per month from the same $500,000. You've actually increased income by 55% while likely reducing volatility. Now, the inflation reality. Yes, 8% nominal yield in a 4 to 6% inflation environment means your real return is only 2 to 4% after inflation. It's not a wealth-building strategy, it's a wealth preservation plus income strategy, and for retirees, that's exactly what's needed. You're not trying to beat inflation dramatically, you're trying to live comfortably without touching your principal. But here's the part that should bother you. The fee structure. Average CEF expense ratios run 1.2 to 1.5% annually. That's 24 to 30 times higher than a basic index ETF at 0.05%. So that gross 8% yield becomes 6.5 to 6.8% net after fees. You're not actually pocketing the full advertised number. For JPI specifically, the expense ratio is lower, around 0.35% to 0.40%, because it's an ETF with simpler mechanics. That's one reason it's become more popular than traditional CEFs recently. The math actually works better. Here's what I need you to understand before you start opening brokerage accounts. Monthly dividend funds solve a real problem. How do you generate predictable monthly cash flow from investments without destroying your principal? They're not designed to compete with growth portfolios targeting 12% annual appreciation. They're designed to compete with bonds and treasury ladders. And on that basis, they're significantly underrated. But they're not free money. You're paying fees. You're accepting lower capital appreciation. You're assuming the fund manager keeps their strategy consistent. And you're vulnerable to discount widening during market stress, though if you're not panicking and selling, that's actually an opportunity. The demographic reality supports this trend. Retirees over 65 now control $80 trillion in assets. 42% of those investors explicitly state monthly income is their primary goal. Since 2020, monthly paying fund launches have grown 23%. Money is flowing into this strategy because it works for the specific problem it's designed to solve. So my recommendation? Don't choose between growth or income. Use both. Build the core of your portfolio from index funds for long-term growth, but carve out 20 to 30% for income-focused funds if you're within 10 years of retirement. That's where monthly dividend CEFs and equity premium income ETFs actually shine. Start by studying JPI's monthly reports. Understand its covered call strategy. Then compare it to traditional CEFs using CEF Connect's website. They have free data on every fund's NAV, discount, and distribution breakdown. Make decisions from data, not hype. The strategy nobody mentions isn't secret. It's just overlooked because it doesn't sell the exciting narrative of doubling your money. But for people who actually need reliable income, it's exactly what works.